When you have a crisis in confidence, you get a decrease in people's willingness to buy stocks in bonds and so forth and so on. So there's a massive decrease in the value of stocks and bonds. Most 401ks or retirement plans are in this kind of paper. Now, this may be a shock to people, but the stock market is run on emotion. It's not run on true economic fundamentals. It's not. And so the stock market can be controlled by the press, which it was, and so it crashed. There has been a bounce back. I mean, the stock market went from 14,100 and something down to, I think it got as low as, I don't know, 67, 6,800 if memory serves me right. And it's retrenched a bunch of that. The stock market is currently trading at about 11,000. People need to understand, however, that these are bets. You have your money in the stock market. It's a bet, and it is subject to the whims of the press. It is subject to what goes on in government. People don't have control of their stocks. They just don't. Doesn't mean that there isn't some individual stock out there that might be good. I'm not saying that. What I am saying is that the equities markets are controlled. The equities markets are subject to this kind of fiscal irresponsibility. They are the effect of that. And if I'm a person that's getting ready to retire, and I've got a bunch of money in my 401k, and it got wiped out, but now it's coming back, and I'm kind of hoping that it's going to be okay. Understand that you're not in control here. I'm not a fan of the equities markets. I'm just not a fan of them. And if you've got bonds, interest rates have nowhere to go. Interest rates are at zero. They can't get any lower than they are. So if you have bonds get less valuable as interest rates go up. If you have municipal bonds, for instance, if I sell you a bond that's going to pay 10%, which is not happening these days, but let's just, for round figures, so you have a bond now that's worth 10%, that's paying 10% interest. Now let's say interest rates go to 15%. For you to now sell that bond, you're going to have to discount the principal of the bond, because the potential buyer can go somewhere else and get 15%. So why should I buy your 10% bond? I'll buy your 10% bond if you discount the principal so that it matches the 15%. So that's the example. Those rates are not in existence currently, but that theory is applicable. So as rates go up, bonds become less valuable. And a lot of retirement accounts are in municipal bonds and so forth and so on. And I do not, just as a personal opinion, I don't have a crystal ball here, but if you look at what the government is doing, how rates have to go up, the logical conclusion is the bonds are going to suffer. So I'm a big fan, at least at this point, of precious metals. Silver much more than gold. I recommend that in the book, and I remain a very strong proponent of that, because those commodities, which they are, go up when the dollar goes down, and of course they have. I've been recommending silver since it was $4 an ounce. It's currently trading at about $26 or $27 an ounce. Past results are no guarantee of future results. I have to put those kinds of disclaimers in. These are just my opinions, but they're based on certainly what I believe to be sound economics, and they have proven true over the last several years.